As someone looking to invest in any kind of way possible, one of the most important calculations that you can perform is the IRR, which stands for the internal rate of return. This calculation is really powerful because it essentially tells you the real rate of return per year that you're getting for every amount of money or every single dollar that you invest in a particular thing. So internal rate of return, as you can tell by the name, it sounds quite complicated and there are many videos that you can check out there on the subject, but in this video I want to really focus on with you and provide you some really practical examples so that you really understand this concept and can apply it in the real world so that you can make some great investment decisions. That being said, let's jump directly into Excel. Okay, so in order to really understand the IRR at a good level, I found that it's very helpful if you can see an actual practical example of it and why this calculation matters in the first place. So as you can see right now, we're looking at a DCF template, and this template has the cash flow statement, it has the balance sheet, and we has the income statement. And the cool thing about this is that you can just simply change the company ticker, as you can see right now, and all of the data automatically updates for you. Now we're gonna bring this back to Apple, and there's gonna be a link in the description of this video so that you can access this template as well. This is using Y-Sheets formulas, as you can see right here, to be able to pull the data, but you don't need to have this template or any of this to calculate the IRR. I'm just showing you a practical example of how this is applied. And the way that this is applied in finance and investments is that you have a whole bunch of historical data right here. Then you're able to do your own research and your own analysis, and then you figured out, you know what, based on my own research, I found that I expect Apple, for example, in this case, revenue to grow at these rates for this period of time. These are just dummy numbers, by the way. You can just simply change them to whatever you want. I expect, for example, in this case, we have research and development to the expenses to grow at this rate, and all together, what this comes down to is this. You have the projections of the free cash flow that a particular company, a particular investment is going to generate for you. This is where you then apply the IRR formula so that you can determine the real rate of return of a particular investment. So based on our assumptions, this is the free cash flow that we can expect in this case for Apple. So if we were going to invest in Apple based on these assumptions, what would be the IRR? Well, we're about to answer this question right now. The way that you set up the IRR calculation is that you need to have some projections like you're seeing right now. And the main thing usually that's analyzed is the free cash flow, but it really depends on what kind of asset you're analyzing. If you're analyzing something like real estate, it could be different. Oftentimes what you use is the net operating income of a particular property or investment. But in this case, we're looking at free cash flow because we're looking at Apple as a stock. So you need to have your projections right here into the future, which you can see. But here you need to have the investment that you're making. And usually this is entered as a negative number. So in this case, for the investment that we're gonna make in this hypothetical situation, the investment that you need to make is equal to the current value of the company, which you can find using Y-Sheets formulas like I'm showing you right now. So I'm gonna get the market capitalization. This is the current value of the entire Apple company. So this is about $2 trillion. I'm just gonna expand it right here and add some space. Yeah, this is a massive number, as you can see. And the important thing here is to have this as a negative. So there we go. Now we have it as a negative, and now we can calculate the IRR, or the internal rate of return. And the way that you do this is super simple. You just type equals IRR, and Excel already has a formula that does this calculation for you. All you need to do is select all of the different cash flows, just like this, click enter, and as you can see right now, you're going to get a num error. And that is because the cash flows are not high enough to justify the investment that you're making. Like you can see right now, this is 1.4 trillion, and the investment that we're making is is 2.6 trillion. So this is why this is a good example of knowing how the formula works. Something that is very important to know about the IRR is that it must be a positive number. If it's a negative number, then the formula doesn't work. So let's just say that we expect this cash flow right here to be different. So we're gonna change it to this number right here, which I believe is like 5 trillion. And now we should get a positive number. So let's see if this is the case. So now we have the formula right here, click enter. Okay, now there's one more thing to know, and that is the fact that as you can see right now, we adjusted the final cash flow and we are still getting num. When this happens, you can use an online calculator online, but what this essentially means is that Excel is not able to compute the IRR due to the irregularity of the cash flows. If this happens, what you need to do is you're gonna just need to change the cash flow. So for the sake of simplicity, let's just say that we're gonna get this for every single year right here. And the main problem that we're seeing is the irregularity of the first cash flow, which was very, very different than the initial investment made. And that's why the IRR calculation was not possible. But as you can see now, we're able to get the real IRR, which in this case is 205%. And this represents that on a yearly basis for our money, we are earning 205%, which means that for every $1 that we're investing, we are getting $3.05 back in terms of the return that we get from our initial investment. Now, as you can imagine, it goes without saying that a higher IRR is better if you have that investment opportunity available to you. The only thing to keep in mind is that be careful, because investment opportunities that have a higher IRR or return on investment, which is a very similar term, usually means that they have some risk involved. So if you're taking a higher risk, you should be definitely be getting compensated more. But keep in mind the relationship between the risk and the return that you're getting, because sure, you might be getting a potential high return on investment, but at the same time, you're taking a lot of risk. So there's a very high chance that you're going to lose your money and not generate the return that was promised to you. Now you know how to calculate the IRR for a particular investment or project that you have in mind. So be sure to use this information so that you can make some great investment decisions for yourself, for your family, for those people that you most care about. If you've enjoyed this video, make sure to subscribe and turn on the notification zone so that way you get notified every time we release a new video like this that's gonna allow you to take your investing game to the next level.